Good evening, everybody. Happy Sunday. It's the 25th of September. I hope you guys are hungry because the lies are going to continue to be fed. Let's get started. I'm your wealth guy. Let's talk money. Let's talk Sunday night market preview. All right, everybody, welcome back to another episode of Sunday Market Preview. I really hope you enjoyed today's episode because it is getting very, very concerning out there, and I want to help keep you on the right side of this market. Please feel free to comment down below. I'd love to hear what you have to say as far as the content today, as well as the information and what your thoughts are on the markets and the economy going forward. But let's jump into what happened last week, because last week we saw the markets take another 5%, nearly 5% hit. Now, if we look at it overall, that pushes pretty well every index well at the level of bear market territory again, testing June's lows before we saw that wonderful bounce. And I told everybody, do not trust the bounce and do not jump in. Most held off. That's fantastic. But let's keep an eye on what's going to happen moving forward, because I don't think that downside slide is going to end yet. We may see a little bounce, but I think we have a lot more negatives to go. In fact, we're now starting to hear rumblings from major institutions as well as major analysts also finally joining us here, saying that the markets could see another 20 to 30% downside from here. But let's talk about the markets and inflation. Let's talk about the interest rate from last week. So we know that Fed Chair Powell increased rates again by 75 basis points, which were anticipated, especially after the last CPI report, which showed that the inflationary numbers had jumped up again. But it was really more important of what Powell had to say afterwards that really is concerning. So the first thing that Powell said was that the economy is going to continue to slide and we can expect more job losses. And this has been a message that Powell has been saying for quite some time. In fact, other talking heads of the Fed and FOMC have also said that same thing. We're also hearing that now starting to rumble from the European Union. Again, more concerning as we talk about the global economy and how the global economy is continuing to slide, even though it's not an argument of whether or not we're in a recession anymore, because every nation is now in that territory. The question is, how deep will this recession go? How long will it last? I think we're just at that tip. It's going to go much, much further. Not going to get into that tonight, though. Let's talk about inflation, because inflation will continue to go to the upside. In fact, because of that, Fed Chair Powell also stated that we can anticipate high rates going into 2023, into 2023. Again, he's expecting us to have job losses, so he thinks the economy can handle these increases going forward. The other thing that they also mentioned was that he says that central banks do have meetings and discussions, but they do not have a coordinated effort, which I think is more garbage to be fed. So I hope you're hungry, because there are a lot of lies that are going to be thrown at us over the next little while, including how great the economy actually is, even though by every single metric that's used to forecast the economy and the markets, every single one of them points to a negative future. But we've been saying this for quite some time now. We've been talking about this for at least the last 8 months, that the markets, the economy, everything has been in free fall. Now, one thing I do want to talk about are the 10-year yields, because we saw some incredible price action in 10-year yields last week, including Friday's close, where we saw the 10-year yield move aggressively back to the downside after the markets were down nearly 1,000 points. What an incredible turnaround. By the end of the day, in the last hour, in the power hour, we saw the markets pull significantly, about 50% off the lows. We also saw that 10-year yield come down aggressively as well. Now, when you see that kind of price action, especially at the end of the day, it is not average Joe going out to buy these bonds. Nope, nobody wants the debt. Instead, it is the central bank who's come in and trying to save the market. After all, imagine another 1,000-point drop at the end of Friday. What a great way to go into the weekend, even though 400 and change was bad enough. Now, even if we take a look at the markets here, and it is very, very early in the trading session, the overnight session, we can see that already futures are pointing into the red, now inching officially into bear territory for all three indicators, or all three indices, I should say. And what do I see going forward? Well, here's what we really need to focus on. Number one, that 10-year yield. We're going to see some aggressive movements to the upside. In other words, a massive sell-off is going to continue. And here I believe that the sell-off is now uncontrolled. I do believe that the Fed is in a little bit of a panic mode here. Central banks are in a little bit of a panic mode, and they are doing what they can to stabilize the yields in the debt market. You see, the debt market essentially needs to be stable. That is the function of the 10-year yield, or the debt market. If we see aggressive price movements, that instability indicates that the markets in itself are unstable, and that is usually an indicator of an aggressive sentiment to the downside. So keep that in mind going forward. This instability is not favorable. Whether it's up or down, it is not favorable. The debt market needs to be stable, and we're not getting that right now. The other area we need to focus on this coming week is the U.S. dollar. As the U.S. dollar was firmly above $1.13, its relative strength, that is concerning, as well as people flee to the US dollar in times of fear. So the markets continue to drop. The yields, or the debt market, continues to see a sell-off. The US dollar skyrockets, and remember, it is a relative strength because it's still losing actual strength or actual value at a rate of 8.3 or 8.4% according to the last CPI numbers. Now, that being said, I do feel that the markets are going to have some continued pressure this week. Although I don't know if we're going to have a little bit of a bounce. It wouldn't surprise me if we saw a day or two here of some leveling off or a little bit of some positive sentiment. But I think overall, the markets will see continued negativity because this week we do have some important numbers. We do have durable goods coming in, consumer confidence, and new and pending home sales. All three of those, plus the PCE, can very much indicate more negative sentiment, and I anticipate they will. So just keep that in mind. Expect the future to be very bleak. I really don't see much of an upside here, at least till the end of the year and easily into January, February. Our numbers will not be positive. They will continue to show some negativity. I do think the US dollar is going to be a key indicator. If it continues to move aggressively to the upside, we can anticipate that the markets will continue to pull, as well as that instability in the 10-year yield. But that's it for today. I'm going to keep it short. I will see you at the opening bell.